Let's talk about the Chapter 10 problems. I have the computational exercises on the screen for Chapter 10. In your book, they're on page 44 of Chapter 10. If you're looking at your ebook, just go to Chapter 10 and click on the computational exercises. Once you get into Chapter 10, it'll take you right there. So for question 16, Inercio contributes $100,000 in exchange for 40% interest in the calendar year ABC LLC, taxed as a partnership. This year, the LLC generates $80,000 of ordinary taxable income. Inercio withdrew $10,000 from the partnership during the year. Inercio is taxed on what amount of ABC's income? On how much of the $10,000 distribution will Inercio be taxed? So this question goes into, basically once you have an LLC and money comes out, and you earn some, obviously you earn some of your percent of earnings and stuff like that, then what's the tax situation going through? And remember that this is a flow through, so it is an LLC. The business itself does not pay the tax. It flows through to Inercio's personal return. So with this one, the partnership made $80,000 worth of income, and he'd receive 40% of that. So $32,000 of that would be taxable income that would go to his personal 1040. So it'd be ordinary income of $32,000 on his personal tax return. Distributions are not separately taxed, so taking $10,000 out is not a taxable event. He put $100,000 in. He can take money out, so it's just taking his money back out of the partnership. There's no tax situation there. So just 40% of $80,000. Which is $32,000 is his ordinary taxable income. Question 17, Henrietta transfers cash of $75,000 and equipment with a fair market value of $25,000, and the basis in that was $10,000 in exchange for 40% profit and loss interest worth $100,000. So question A, how much is Henrietta's realized and recognized gains? Henrietta has a realized gain, but none of it will be recognized, which is the key. So there's no tax situation on this at this point. So putting in $75,000 of cash and then $25,000 of the fair market value with that basis of 10. So there is a $15,000 gain, but none of it is recognized. So there's no tax on that at this point in time. Remember that when you are contributing assets to a partnership, there's no economic change. It's kind of going back to when we talked about the formation of Schedule C corporations. When you're contributing assets to that corporation, you still own them. Now you own them through your business. There's no taxable event there. The basis will matter though. So if that basis gets transferred in the course of the business, goes and sells that, and at some point in time, there will be potentially a capital gain to pay. B, what is the amount of Henrietta's basis in the partnership interest? And I probably already answered that, but it's $85,000. Basically, the 75 plus the 10 basis. So 10 plus 75 is the 85. And then what's the basis in the contributed equipment for the partnership? It basically just gets the carryover. That 10,000 basis just goes right to the partnership. So if the partnership then sells the property, and there's a fair market value of above 10, that would be a gain. That the fair market value minus the 10,000 would be the gain. Okay, question 18. Wozniak and Wilcox formed Jewel LLC, with each receiving a 1/2 interest in the capital and profits of the LLC. Wozniak receives his 1/2 interest as compensation for tax planning services he rendered prior to the formation. Wilcox contributes $50,000 worth of cash. The value of a 1/2 capital interest in the LLC is $50,000. So letter A, how much income does Wozniak recognize as a result, and what is his character? So Wozniak provided services. That's kind of the key thing, and I'm assuming you kind of picked that up as you looked at that. So Wozniak provides services, in return receives 50% interest of the LLC. So that's providing services, which means that's taxable income. So basically, Wozniak recognizes ordinary compensation income from the LLC and would be taxed on that on the personal tax return. Letter B, how much is Wozniak's basis, and then how will Jewel treat this amount? So Wozniak's basis is just simply the value of services provided. So $50,000 becomes the basis in the partnership. And of course, what the LLC would do is treat that as some kind of an expense. That'd be a $50,000 expense for the services provided. So it's deductible when it comes to tax planning. Now, the key also, though, is that would be a part of either organizational or startup expenses, and they could treat it as such. There's a you can go $5,000 worth of that can be capitalized, and then there's a $50,000 amortization, as we talked about in the chapter. So they would take advantage of some of those rules, but regardless, it would be an expense. Question 19. On January 2nd of the current year, Fenton and Myers, FM, their contributions to the LLC are as follows. So they contributed from Fenton cash, receivable inventory. You can see the basis and the fair market values. And Myers just puts in cash. So one person puts in cash, receivable inventory. The other puts in just cash. Within 30 days, FM collects on the receivables. So they're all due within 30 days and they're all collected. And they sell the inventory for its fair market value of $60,000. And then how much income does FM recognize from these transactions? What's the character? And why does this result apply? And the chapter definitely mentions this. FM recognizes $90,000 of ordinary income because this is receivable of inventories. It wasn't more of a capital asset that was transferred. It was assets that would be just part of the day-to-day operations of the business. So that $90,000 would be ordinary income. As soon as the cash is collected, it's ordinary income. And then for the inventory, it would recognize ordinary income of $35,000, basically the value of $60,000 minus a $25,000 basis. So that difference is $35,000, and that's the income. So 90 plus 35. So basically, it's a rule that the Chapter 10 talks about. The rule exists to ensure that a partner and partnership cannot transfer property between themselves and alter the inherent character of the underlying deferred income gain, loss, or deduction. So that's more of just an ordinary asset that the business would use. It's not a capital asset, so we treat it as ordinary income and not a capital gain. Clearly, if it was a capital gain, we get the favorable tax treatment. But as ordinary income, we just get the normal tax treatment. Okay, I'm skipping question 20, but we'll go down to question 21. Question 21, Penguin LLC operates a large apparel store with several employees and substantial debt. Each LLC member is active in the business and receives compensation from the LLC. The LLC invests its excess cash in government and corporate bonds, blue chip stocks, and a global mutual fund. It owns properties subject to accelerated depreciation. What types of information must Penguin accumulate and report on its Schedule K? So I'll refer you to page 28. And page 28 of your chapter is where they discuss the K1. And I'm just going to flip there right now. And that's the actual K1 is on that page. So as you think about the answers to this question, literally just go to page 28, take a look at that, and just go, what's it asking me to complete? And it's asking for ordinary business income. There's about 3 parts to the K1. Part 1 is just kind of the informational, just basically identification number, partnership's name, address, stuff like that. And then part 2 is information about that particular partner receiving that particular K1. And the one they show us is for Maria. Remember, that was the beach cider, the bakery business, and that's all the information about her, what her profit and loss sharing is, what her capital account balance is, the change in her capital account balance, what method is being used to compute that the tax basis or GAAP basis or something else. And then part 3 is the dollar amounts. So part 3, if you look at that, and because part 3 really kind of relates to some of this type of information here about Penguin. And remember that on part 3, we have the information that's coming directly from the partnership's 1065, and then we have those separately stated items. So some of the items that we receive are kind of the same for everybody because they'll be taxed the same on that information, but some of the other information it has to be separately stated because maybe one partner is at the highest tax bracket and maybe is itemizing. Another one is at a middle tax bracket and maybe not itemizing, or whatever that combination is. So some information is what they call separately stated. And Maria is a 40% owner, and we get 40% of the Beachsiders amounts specifically. Okay, so that's a really good example to follow. But some things to just point out. So I'm looking at page 28. I'm looking at part 3 of the K1. I'm looking at ordinary income, line 1. Guaranteed payments to LLC members, because remember that's taxable to the member receiving those. Potentially, if the business interest expense limitation applies, partners can report excess interest and carry it over into future years. That's a possibility. That one does not apply for the one on page 28, but that's a possibility. Various types of investment income, dividends, they're taxable and tax-exempt interest, lines 5, 6, and 18. That matters, obviously, right? Because if there's qualified versus ordinary dividends, the tax rates are different, right? So we don't know what Maria's tax bracket is, but she might pay either 15 to 20% on that. Gains or losses, if there are any, either short-term or long-term, they're taxed differently. Short-term are ordinary income. Long-term are receive favorable tax treatment. Earnings from self-employment, that matters because that helps you compute what your self-employment tax is on your personal 1040. If there was a foreign tax credit, anything involving what they call the AMT, alternative minimum tax, investment income and expenses. If the Maria, the owner, is electing to deduct investment interest expense, that's on line 20. Information, the LLC members need to calculate their qualified business income deduction, the QBI, so that's needed also. And then that's pretty much it. So just kind of think through when they're asking that question, they're really just referring to part 3. And there's in some of the information, every partner, it's the same. Some of the information, it's separate only because the partner's personal tax returns need that information, and they're taxed potentially differently. So kind of think of your personal tax class, which I know a lot of you just got done taking, and think, what kind of information do I need to fill out somebody's personal 1040, and that's what you're kind of thinking through. So that's what they mean with that question. So just informational, and just take a look at page 28, part 3, and that's really what they're asking you to do. Question 22. This year, Tasty Partnership reported income before guaranteed payments of $92,000. Stella owns a 90% profit interest and works 1,600 hours per year in the business. Euclid owns 10% with a basis of 30 at the beginning of the year and performs no services for the partnership during the year. For services performed during the year, Stella receives a salary, kind of quote unquote, of $6,000 per month. Euclid withdrew $10,000 from the partnership as a normal distribution of cash from Tasty, but not for services. So A through B or A through D down here, what is the amount of guaranteed payments made by the partnership for the year? The $6,000 quote unquote salary, okay, that's the one right there. So you can see that that $6,000 is a guaranteed payment is really what it is. 6,000 obviously times 12 for 72,000. Okay. Question B, how much is the partnership's ordinary income after any permitted deduction for guaranteed payments. Okay, so take a look at what their income was. The income before guaranteed payments was $92,000. We just established through letter A that there was $72,000 worth of guaranteed payments. So the answer to B is 92 minus 72 to get down to 20. Letter C, how much income will Stella report? Stella reports $90,000 of ordinary income, including her guaranteed payment, and then 90% of her partnership's $20,000 ordinary income. So let me just do this one in Excel so you see it. So this is what Stella's receiving. Okay, so she's receiving $72,000. So the ordinary income is 92. Okay, I'm going to say OI for ordinary income. I'll do GP for guaranteed payments, and she's getting $6,000 a month times 12. Okay, and so basically the profit after that is 20. We can all see that. She gets 90%. Okay, so she's going to receive 90% of that on her personal return, $18,000. So what she's receiving is the $18,000, her share of the earnings, and then add to that the $72,000 guaranteed payment. So her income is $90,000. And then letter D, how much income will Euclid report? Euclid only gets 10% of the ordinary income. So going back to here, that $20,000, Euclid just simply gets 10% of that. So I'm just going to take 0.1 times that. We all know it's 2,000. The $10,000 payment to Euclid, let's go back and talk about that. So Euclid withdrew $10,000 from the partnership as a normal distribution of cash, not for services. Okay, and that's probably one of the key things there. So it did not exceed the basis. The basis was $30,000, so $10,000 was taken out. That's not a taxable event. It's not deductible by the partnership. It's not taxable to Euclid. Okay, so this kind of is some of that's really kind of some key stuff there for question 22 that partnerships deal with regularly. So that's a good problem. Just kind of make sure you have a good handle on. Thankfully, it's really straightforward. Okay, question 23. When Paget Properties was performed, Nova contributed land, value of 200, basis of 50, cash of 100. Oscar contributed cash of 300. Both partners are 50-50. Letter A, how is the land recorded for 704B book capital account purposes? Okay. Paget records the land, so Paget is the LLC, at its $200,000, the value of $200,000. Okay, so on the books of Paget, there was a land asset account worth $200,000, the fair market value. What is the basis for Paget, though? Remember, the basis just transfers, so Paget's basis is 50. So if they ever sell the land, and assuming they sell it for more than 50, they'll have a capital gain. Whatever they receive minus 50 is their capital gain. If Paget sells the land, which is, I guess I just got ahead of myself, and even look at these beforehand, and I forgot that. If they sell it for 300, so what happens then? And this is kind of the key. Now, Nova contributed the land, right? So that's the issue here. The land sold for 300 at some point in the future, so the value's gone up. It went from 200 to 300. How much tax gain will Nova and Oscar report? So remember, Oscar is the other partner. So this is for Nova and Oscar, the two folks that contributed to the LLC. So Nova will report a $200,000 gain, and Oscar's gain will be $50,000. There's a pre-distribution gain. Okay, everybody can see that. The 200 minus the 50 is a pre-distribution gain. That's $150,000. Okay, so the pre-distribution gain of $150 is allocated to Nova. So Nova receives that. The other $200,000 gain, I'm sorry, getting ahead of myself there. The $100,000 post-contribution gain, though, is allocated equally. Okay, 100,000, 50/50. So let's just work this one out. I think that'll be easier. So we know that there was a $200,000 fair market value and a $50,000 basis. Okay, and so we all know there's a gain here of 150. That goes to Nova. Okay, the property was sold for $300,000, and we subtract the $200,000 from that. Okay, and so we can all go, there's another $100,000. Okay, that $100,000 is split 50/50. Okay, so we all know what that number is. This is 50,000. Okay, so Nova's gain is the 150 from the pre-distribution gain plus half of the 100. So Nova gets 200, and then the other partner, whose name I just forgot, is Oscar, who gets the other 50,000. So 300,000 minus 50 is 250 of gain, right? So I've got 250 of gain to allocate. 200 goes to Nova, 50,000 goes to Oscar, right here. Okay. And that's one of those separately stated items, right? So that's because the gain's separate and all that kind of stuff. Go back to question 24. At the beginning of the year, Barnaby's basis in the Triple B partnership was 50, including a 5,000 share of partnership debt. At the beginning of the year, his debt was 8. His share of the partnership's income for the year was 20. He received a cash distribution totaling 12. In addition, his shares of the partnership non-taxable income was 1,000. How much is Barnaby's basis at the end of the year? And that's one of the calculations you do on the K1, is you are looking at each partner's beginning capital balance, making the adjustments to get to the ending capital balance. That's essentially part 2 of the K1. So that's where this question is coming from. Let's take a look at Barnaby here. So beginning was 50, including a $5,000 debt. At the end of the year, debt was 8, and then income was 20, cash totaling 12, and partnership non-tax income of 1,000. Okay, so that's what's going on there. So let's go ahead and do this one. So let's take the initial of 50. I'm just kind of find an area down here. So the initial was 50. I'm just going to round. And then from that 50, we have to then go with the increase in debt. And the increase in debt was that it was 8 at the end of the year and 5 at the beginning of the year. So the debt went up by 3. Okay, so a 3,000 increase. It ended at 8. It began at 5. Also, he received 20,000 as his share of partnership income. And then he also received 1,000 for his share of tax-exempt income. He took out 12,000. Okay, so the sum of all that, hopefully that works out the way I wanted to. Yep, it does, 62,000. Okay, so to recap, his beginning was 50. There was an increase in debt by 3,000, 8 minus 5. There was a 20,000 share of income, a $1,000 share of tax-exempt income, a withdrawal of 12, ending balance is 62. And then for 25 is kind of along the same lines. On June 1 of the current year, Alicia and Ezra, equal partners, contribute property to form Double E. Alicia contributes 200,000. Ezra contributes a building and land with an adjusted basis and fair market value of 340, subject to a liability of 140. The partnership borrows 20,000 to finance construction of a parking lot in front of the building. At the end of the first year, which is now December 31, the accrual basis partnership owes 8,200 in trade accounts payable to various creditors, and the partnership reported a 30,000 worth of net income for the year, which they share 50/50. Assume that Alicia and Ezra share equally in the partnership liabilities. How much is Alicia's basis in the partnership interest, and then how much is Ezra's? So we'll look at each one separately, okay? And so, let's go back to Excel and compute this. so let's do Alicia first and remind ourselves what Alicia contributed. Okay, Alicia contributed cash of 200. Okay, so let's do this one right here. So cash of 200, that's the initial contribution. And I'm going to do these with all the zeros. Okay, and then it's increased by a $70,000 share of liability in the contributed land. So remember that Ezra contributed land that had a liability of 140. Okay, so half of that goes to Alicia. The construction debt, remember the property, the parking lot, I should say. So they borrowed 20 grand to finance a parking lot. That's half of that. And then the accounts payable debt is 8,200. Half of that is 4,100. Okay. The partnership made 30,000. Half of that goes to Alicia. 15,000. Add that up, we get 299,100. Okay, so this is Alicia. Now let's go with Ezra. Okay, so Ezra, remember what Ezra did. Building and land, fair market value of 340, the liability of 140. And the key here is it's exactly the same. Okay, so the net, the only difference is this was cash, and then for Ezra it was just really 340 minus the 140 to get down to 200 again. And then you get half the debt, half the parking lot. I'm not rounding. I should be typing in the full amount. So 70, 10, 4,100, then half of the income of 15. And they have the exact same answer, except I didn't do this right. Oh, I typed in one too many zeros. There we go. Now I got it right. Okay. So Alicia, Ezra, they're the same. Okay, question 26. Jocan contributes a non-depreciable asset to the Mahali LLC in exchange for a 1/4 25% interest in capital profits and losses of the LLC. The asset has an adjusted tax basis to Jocan and the LLC of $60,000 and a fair market value of book basis on the contribution date of 150. The asset is encumbered by a non-recourse note of 40 that has not been guaranteed by any LLC members. How much of the non-recourse debt is allocated to Jocan, and what is the amount of Jocan's basis in the LLC interest following the contribution? So Jocan, let's just kind of think through here what's going on. So there is a basis of 60. Okay, the asset has a basis to Jocan of 60 in the LLC. So that's the first place we start. Then we subtract the debt. We subtract the 40,000 debt. And then we add back 25% of the debt. Okay, so let me show you that in Excel just so you can see the numbers. So we go with the basis. Then we add the debt. And then we subtract the debt. Then we add back 25% of the debt. Okay, 10,000. And so the sum of all that becomes 30,000. Okay. So the way this works is we take the basis, we reduce it by the debt assumed by the LLC, the full 40,000, and then we allocate the profit and loss sharing 25%, which is 10,000 back, giving Jocan a $30,000 basis in the LLC. Okay, I'm skipping 27, so we'll go down to 28. Heather sells land with an adjusted basis of 75, fair market value of 95, to a partnership in which she controls an 80% capital interest. The partnership pays her only $50,000 for the land. How much loss does Heather realize and recognize? If the partnership later sells the land to a third party for 80, how much gain does the partnership realize and recognize? So letter A, how much loss does she realize and recognize? As of now, nothing. That would be the answer. At the original sale date, she had a realized loss of 25, and we can all see that $75,000 basis, and the partnership pays her $50,000 for the land. So that 75 minus 50 is the $25,000 loss. But the sales is to a related partnership, so none of the loss is deductible because she sold it to a related partnership. Letter B, if it later sells the land to a third party for 80, how much gain does that partnership realize and recognize? You can probably just imagine what that would be. We sell it for 80, and the basis that we carried over was 75. So even though they bought it for 50, they inherited the basis of 75. So that $5,000 difference then is the taxable gain for the partnership. So the partnership sells land to an unrelated party for 80. It reports initially a gain of 30, $80,000 selling price, minus a $50,000 cost basis, but then they have to offset that gain by the $25,000 loss that Heather did not deduct. So that gets us down to the $5,000. So let me just put that in Excel so you see it better. I don't think I explained that quite as well as I should have. So the initial gain is, think of it like this, 80,000 selling price. So I'll do SP for selling price, minus what they paid for it. Oops. So we'll just go cost. Okay, so that's the initial $30,000 gain. But that's not the end of the story. Okay, there was a $30,000 gain. However, remember that she had a $25,000 loss. Okay, and that's really the key here, is that loss. And so after you take that loss out, add these two together, then we get a $5,000 taxable gain. Okay, so $5,000 taxable gain. Okay, let's go back and do the next question, question 29, next page. So I'm going to do a couple of problems with you too. So I'm going to work on 29 and 30. So the problem 29, Emma and Lane formed the equal EL partnership. Emma contributes cash of 100. Lane contributes property with an adjusted basis of 40 and a fair market value of 100. How much gain, if any, letter A, if any, must Emma recognize on the transfer, and then must Lane recognize any gain? If so, how much? And hopefully by now you're realizing, well, they just contributed property they already owned to the partnership. That's not a taxable event. Okay, so they contribute those items. The partnership receives the basis. There's no taxable event there. Letter B, what is Emma's basis in the partnership? Well, Emma contributed $100,000 worth of cash, so her basis is $100,000. Letter C, what is Lane's basis in her partnership interest? Lane will take a $40,000 basis in the partnership interest, which is the basis of the property contributed. Okay, so it had a fair market value of 100, but the basis is what counts here, which is 40. What is letter C? What is Lane's basis in her partnership? Which is what I think the one I just answered. So B 100, C 40. Letter D, got ahead of myself. What basis does the partnership take in the property transferred? It takes the carryover basis, so the 100,000 basis in the cash plus the $40,000 basis in the property. It steps in the shoes is essentially what the chapter tells us. So pretty basic stuff, but I just want to make sure you understand that. Understanding that's important to be good, to do well in the homework. So question 30, we'll make that our last one. Kenesha and Shauna form KS LLC, equal partners, a cash contribution of $360 from Kenesha, and a property contribution basis of $380, fair market value of $360 from Shauna. How much gain or loss, if any, does Shauna realize on the transfer? Does Shauna recognize any gain or loss? If so, how much? So clearly, she contributed a property that was upside down by 20,000. Basis was higher than fair market value by 20. So Shauna has a realized loss of 20,000. However, the general rule is that no gain or loss is recognized to a partnership or LLC or any of its partners upon contribution of money or other property in exchange for a capital interest. So there is no recognized loss. Okay, so there's no taxable loss for her. B, what is Kenesha's basis? The basis is the basis of for Kenesha. It's the $360 worth of cash. So the cash she contributed is her basis. Letter C, what is Shauna's basis? Shauna's basis is the fair market value of the basis of 380. Okay, the basis of 380. Letter D, what basis does the LLC take in the property transferred? Letter D, the answer is 380, the basis that it received. So it just steps in the shoes and gets that basis. Letter E, are there more effective ways to construct the formation? You should probably recognize that, yeah, there should be. A better, more efficient result would be for Shauna to simply sell the party to somebody else, somebody unrelated, an outside third party. Realize the $20,000 loss, contribute the $360 to the partnership. That way both just simply contribute cash to the partnership. And then she gets to realize that loss on her own personal return. So that would be important also. So she can look at it from that perspective and go, that would be better off. So that kind of goes back to kind of the same thing we did in the forming corporations, the Schedule C stuff that we did earlier.